Good afternoon, ladies and gentlemen, or I should say good morning for those of you who are based in Europe. Welcome to this panel, The Rise in Demand for Socially Responsible Investment Strategies. That's clearly a topic that has been, a lot have been said and written about that. And it's very, I would say, very relevant topic at this day and age. We have three solid speakers, experts in this field. The first one is James Cheo. He's the Chief Market Strategist for Southeast Asia for HSBC Private Bank. Welcome, James. We also have two gentlemen that are joining us from Europe, so they got up very early. James Purcell, who is a Group Head of Sustainable Investing, Quintet Private Bank, based in Zurich. And last but not least, we have Laurent Simeoni, who's Head of Portfolio Management at ING. So James Purcell, maybe to start with you. You're Group Head of Sustainable Investing at Quintet. You're a European private bank. Do you see differences in approach in a European environment vis-a-vis an Asian environment when it comes to sustainable investing or ESG?
We do see some differences, but we also see some similarities. So the differences is that it tends in Europe that the social conscience at large is probably a bit further developed than it is in Asia. However, that's then offset by the type of wealth that you see in the different regions. Because wealth in Asia is often first generation, it's often entrepreneurial, those individuals tend to have a higher affinity, all else equal, than their European counterparts. There's a bit of a balance here. The overall social dynamics of Europe does make ESG very popular, but the types of clients that you find in Asia for private wealth means that they are also got a very strong affinity to ESG.
Okay, thank you for that. Laurent, we spoke before. You are obviously within ING looking at both advisory as well as discretionary mandates. In terms of sustainable investing and the approach, can you define, do you see differences between the discretionary bit or the advisory bit?
Yeah, I think most of our clients are still have a large conscious about ESG, but they're looking for expertise, for advice on a global side, on the global portfolio. So they're more keen on going into the discretionary part of our activity, to have a global approach on their portfolio about excluding, selecting the right companies. And on the advisory side, it's slightly different. Clients are more looking for thematic funds. They are not yet going into screening companies or things like that. And they're more focused on funds or ETFs, where let's say a large part of our clients are still looking for DPM clients when they're talking about ESG. They're still, let's say, in a learning phase, learning curve about ESG, at least in Europe, I think.
Okay, well, thanks for that. Actually, James Cheo, based in Asia, very often it is said that Asia lags behind maybe North America and especially Europe. I'm not sure if that's still true or not. From HSBC, obviously a giant in the region, how do you see that? Do you see an increased interest from an HSBC point of view, and how do you apply ESG in your portfolio strategies and management?
Well, thanks for that question. I think one of the game changer is this global pandemic. This global pandemic, in fact, has accelerated ESG trends. In many ways, that the pandemic brought people together. Climate change and all these issues associated with ESG is getting much more attention because it could be climate change could be even a bigger threat compared to this global pandemic. And I think there is a realization of that. I think, and that's very important. We are seeing that in governments across Asia. China is actually, even in their stimulus, putting a lot of subsidies for renewable energies and to also encourage electric vehicles. And also, of course, there are certain big draconian rules that prohibits the use of plastics and straws by the Chinese government. So I think the governments are leading it post the pandemic. And you're also going to see a lot of corporations realizing the importance of being social during this pandemic in terms of how to bring the community together. And it's not just at a stage now in the past where there is only a profit maximization at all costs. And Asian corporations are also realizing that there is a need to come together as a society, as a community, to grow together in a sustainable fashion. And I think, of course, in terms of private wealth, James earlier on mentioned that Asian wealth and European wealth, it's a bit different, and Asian wealth is still largely in the hands of first generation. That is true, but also the younger next generation is actually taking on the reins very soon, and also some are already doing so. And therefore, I think the demand for ESG investing is going to catch up or even become much more prominent in the years ahead. And I think that's a very exciting development. So, of course, with the increased demand for ESG investments, the infrastructure that supports ESG would also grow. For instance, the demand for sustainable investments, ESG reporting standards, all these would improve alongside the increase of demand. So I think in the years ahead, it's going to be a much more stronger pickup in Asia when it comes to sustainable investing.
Okay. Well, then maybe moving back to the other James, obviously, I mean, do you indeed see that similar developments in Europe? And how do you engage with your clients when it comes to sustainability?
The demand is undoubtedly increasing, and it's increasing at a fast pace. And the reason for that is quite straightforward. It's simply a reflection of how people live their lives away from the financial markets. If people are becoming more conscious of environmental issues, such as the recent protests that we've seen around the world, if people are becoming more familiar with social issues, this naturally gets reflected into their portfolio. And as private wealth managers, what we need to do is we need to remove the jargon. Even the term ESG is actually a barrier sometimes between the private clients and what they want to do. It's an acronym. It doesn't mean anything to people who haven't heard it before. So we need to strip away the terminology, stop thinking about this as another language, and therefore, with that simple human world, connect their non-financial life with their financial life.
Right. Laurent, when you engage with clients on this topic, do you also encounter clients that are not interested at all, and how do you deal with that?
We still do. In fact, we still do have some clients which are not educated, I would say, to bracket, but also not really interested because they still have doubt about the performances of the ESG investment. But the recent development, as James said, the COVID crisis and the performance experienced by the SRI or ESG products during the crisis were probably one of the last proof that those products are producing very strong returns. And a lot of clients are more and more convinced about that. So they tend to be convinced much easier than in the past when we said we are in a move towards ESG in our process. They're much more interested in knowing how we're going to do that in their portfolio. What are our screening tools? What are our new benchmarks for some clients? Some clients are still looking for comparing their portfolios, getting the ESG investment, but comparing with old benchmarks. I think it's still a reminiscence from the past. We need also to go forward and select new benchmarks. Selecting old benchmarks is just for them a way to say, I need a proof that those products are performing at least as much as the others in a comparable way. And I think the recent development of the COVID are really proving that this is the case. They are performing really well, and that's the proof that everybody were waiting for, I think, at least for the clients.
Yeah. But my experience is that it is important to show clients that performance indeed differentiates. James, at Quintet Private Bank, is that something you use to convince clients, performance?
Absolutely, and we very much want to measure sustainable strategies actually against conventional benchmarks. This should be a toolkit that you can deploy to generate strong investment performance. So just as if there's a manager that may use a value approach or a growth approach, for us, it's about using the toolkit of sustainability and seeing, can we beat conventional benchmarks using that additional information, using those techniques. Whether it's investing in the leaders of the current situation for sustainability, or trying to capture the trend of improvement for various companies, we believe that sustainability is a toolkit and you should be able to use it to beat conventional benchmarks, and that's something that we promote to our clients.
And maybe to stay with you, James, on that topic, because we're talking about sustainable investing, we're talking about how this is now developing, how COVID is an accelerator of that. But what about your bankers, right? I'm sure you have young up-and-coming bankers, and you've been bankers that have been 30 years in the industry. That might be, and you know, I guess the older you are, the more resistant you are to change. How do you deal with that internally?
Speaking, we have a lot of support internally, and that was my experience at my previous employer at UBS as well. And the reason for that is you can align incentives with sustainability really easily. If you have an understanding of sustainability and ESG, your book as a private banker should grow faster than your peers. You can tap into the new sources of wealth, the next generation, the entrepreneurs, the female clients. All of these have a high affinity to sustainability and are growing assets faster than the wider market. So it's in your natural interest to understand this, because you as a private banker will have a superior growth rate in your book. Additionally, if you can make an emotional connection, which is what sustainability is, between the investments and also the client, you have a tighter bond with your client. That's something that you can translate into better retention, and it's something you can even translate potentially into superior price realization. So beyond the idea of doing good for doing good's sake, which many people, of course, warmly embrace, for those that are a little bit more skeptic, faster growth, better retention, superior price realization. It's a really compelling alignment of interests.
Mm-hmm. And the other, James, how do you see that? Obviously, as I mentioned before, you work for a real banking giant in Asia with lots of very senior people in it. Do you see, or do you have to deal with that internal resistance? And how do you do that?
Well, I think I want to touch on what James talked about, emotional. I think that's important, that ESG or sustainable investing is more than just emotional. It's about values. And it's about really at the end an education that is actually not as emotional as what you think. It's actually much more logical and rational in many respects, because it's a lot about educating and letting the clients and bankers understand that companies that engage or do well on the ESG ratings are generally quality companies. And these quality companies tend to perform better in a more uncertain economic environment as we are in. And that during the sell-off in March, what COVID and this whole pandemic has illustrated is that companies that embrace ESG actually do much better. And I believe that in a post-COVID-19 world where things are going to be much more technological driven, where energy is going to be cleaner, where the economy is going to grow at a much more anemic rate, it's very important. And of course, ESG investing, sustainable investing would become at the forefront, because it's no longer one that's just purely emotional, of one that's just wanting to do good. It's very much logical, because you need ESG companies, you need ESG leaders in your portfolios to thrive in a post-COVID-19 world.
Okay, thank you. Laurent, maybe move a bit more to the technical side of sustainability and ESG. Can you tell us a little bit how at ING, if you look at the investment process, how integration of ESG takes place?
Yeah, of course. Let's say when we started that process of, I don't like the word greenification, but we we started that 3 years ago, and we first, as James, the two James have said, had to convince more the portfolio manager than the private bankers, because the private bankers have experienced the trend on the client side. There was more, let's say, issue with educating and getting the portfolio manager on board. But when now that the industry is also jumping on board the greenification train, the let's say the offer, the industry offer is much larger than 3 years ago. It's really easy to now develop and move, not creating only a new product. Let's say 3 years ago, everybody were creating, let's say, an ESG mandate, which was just a niche product on many of the banks. Now we did not choose that way. We decided to move and to reshuffle our whole investment process. We have a long track record of screening companies. We base our screening tools on Sustainalytics data and an internal screening which is made in Amsterdam. We have a dedicated team here which are screening more than 8,000 companies. That helps us defining an ESG investment universe for equities, for bonds, corporate bonds at least. And we also have a dedicated team to select an ESG universe for our funds. That helped us, let's say, move toward ESG for our funds of funds first. We are converting our funds of funds, and we are at the last stage of converting our whole range of funds. And we have started to change our whole investment process also for the discretionary mandates. Introducing ESG ranking for our whole recommendation list, model portfolios, and trying to get non-financial investment score for our global model portfolios. So at every stage of our decision-making process, we have introduced, when it was possible, an ESG criteria. That's the trend. That's a trend we experiencing also on the regulatory side, as the European Commission is introducing, creating now the next step of MiFID, and the next step of MiFID will probably be the ESG step. So we don't want we want to be ahead of that process and be ready for that for 2022-23, I think, and that's why we are moving now and reshuffling the whole process today and not tomorrow.
Right. And maybe to stay with you then, because that's quite interesting. I'm guessing that also has consequences for how you report this to your clients?
Of course, we have to change a lot of things. We have to invest in our portfolio management system in order to adapt them, introducing, as I said, the non-financial scores into the reporting sent to the client. That's not the current stage. That's more in a project stage, I would say. But this is in our scope. And for the moment, we more reporting on clients on a global way about, let's say, our global asset under management. We are producing a report, yearly reports on the Luxembourg side, but also on the ING Group side, to report on the progression we have on collecting and investing in ESG products. We started with funds, with a, let's say, a selected number of funds, which we consider as the most ESG ones. And now we are introducing also, we start introducing some direct equities also, the direct equities which are getting the best ranking in our screenings. But it's much more complicated, and I think you're much aware of that, than just selecting funds and saying, okay, we have collected X millions, tens of millions in those funds.
Right. Well, maybe going to James in Singapore. Can you elaborate a little bit on the integration of ESG in your investment process?
Yeah, well, I think we are trying to make ESG at the forefront of everything that we do. So I think at the discretionary portfolio side of things, that's where we want to start. And then that's where we encourage every investor to hold on to our discretionary portfolio that reflects our house view. And from that portfolio, in fact, all the bonds and equities that are selected are based on ESG score and integration, how we think about ESG. It's all reflected into that portfolio. And of course, it excludes all the generic negative screening sectors that are not desirable for investors. So that's the starting point. But of course, there are various clients who have their own preference. And of course, we do a lot of bespoke work with individual clients on how they think about ESG and which are the sectors that they think they want to invest much more. So that's the starting point. And of course, we do have for others more thematic investments along sustainability, such as clean energy, such as electric vehicles, such as sustainable bonds, etc. So I think there are a variety of ways that investors can actually implement sustainability into their investments. And of course, we also have an avenue of impact investing through various means, such as private equity funds, for example, that investors can actually do good at the same time, but also get stronger alpha in their investing.
Okay, just one more question for you then before I move on to the other James. You're based in Singapore. I remember a friend of mine who lives there complaining that Tesla was not available in Singapore. I'm not sure if that's still the case or not. But one would think, whereas the Singapore government and the monetary authority of Singapore is known to be usually very advanced. Is the MAS involved in sustainable investing? Do they have preferences? Do they like it when banks move that direction, or do they keep quiet on this topic?
Well, I think the central bank in Singapore is actually leading ahead in many aspects in terms of green investing. And I think they have earmarked that as one of the key sectors of growth. Well, you brought up Tesla as an example, but Tesla is just a company. But the overall grand strategy of Singapore is going towards much more sustainability. And I think the government has even created a new ministry, a new cabinet of sustainability. And I think that's the big focus. So there are a lot of plans within Singapore. It's not just in the financial sector, but it's the whole range of things to get Singapore much more electrified, to use much more solar energy. There are plans to build a floating solar panel energy kind of floating platform, one of the largest in the world. They are planning that in the next few years. And of course, they are encouraging as many banks as possible to support the ESG initiative together with the developments in the economy. So I think the Singapore government is actually looking very strategically at sustainability, just like how the other governments are in the region, especially in North Asia. And I think Singapore, likewise, is going to identify these as not just a good to have, but also an area of growth that would power the economy in the years ahead.
Thanks for that. James, I'm based in Hong Kong. I think our regulator and I mean James Purcell, our regulator in Hong Kong woke up to this, I think, give or take 2 years ago, and it's getting more and more traction. You are based in a very green place, which is called Switzerland, and within, obviously embedded within Europe, which I believe is kind of ahead. How do you see regulation moving forward? And do you see differences between the European regulator and the Swiss regulator when it comes specifically to this topic?
Regulation is a huge driver, and really I think there's probably two drivers, one coming from each side. There's the bottom-up driver, which is the people and the clients and their interests, and then there's the top-down driver, which is the regulation. As mentioned by Laurent earlier, the European Commission, so the European regulators and the European politicians are extremely supportive of the sustainable agenda, and through the fiscal policy that Europe's conducting, but also through the financial regulation. In this case, Switzerland predominantly aligns towards the EU, and we move with that. We move with that territory and with that movement that we're seeing elsewhere. What is going to be absolutely crucial is whether the EU standard starts becoming a global standard, and we see other people follow the EU's lead, or whether we see fragmentation and we actually see different standards emerging. I think we can all hope that we see unification of standards, but unfortunately, as we've seen in previous episodes, fragmentation is probably more likely.
Yeah. Okay. Laurent, you mentioned you started, give or take, 3 years ago, really with taking this quite serious and integrating sustainability and ESG in portfolios. That's a relatively short time. Now, fast forward, let's say 10 years, I think probably all banks and financial institutions will have, in some sort of way, some more than others, really adopted this, embraced this. And then it's not, you know, and then, right, so you've done all your screening and negative screening. How do you think financial companies can still distinguish themselves from the competition in the area of sustainability?
Let's say for the moment, since few years, we have just experienced what we call greenification. A lot of companies are just providing annual reports, ESG reports, but now they try to be much more, they try to have an impact. I try to differentiate between companies which are just promoting during TV advertisements. Yeah, we know we have an impact on the society. We have a positive impact on people and so on, and the company which really have an impact, which are reporting and measuring that impact, and are promoting this impact also on the financial markets. You know, there's a cross effect between the interest from people, the interest from the industry, because the industry is, as I said, jumping aboard the train or so, and the offer is developing, and the more the demand from clients will be strong, and the more the companies will have to adapt. All the banks have an ESG policy now. We do have an ESG policy. Clients are requesting us, do you have an ESG policy? And I think that in the coming, not 10 years, but I think 1 or 2 years, a lot of companies will be asked by their clients, do you have an ESG policy? That's already the case for some well-known companies which are on all the positive screening, like Patagonia in the US, which are really not the good student of the sector, but and all the company will have to report, and not only to improve their image using ads, but to make strong reports about their impact on the society, their impact on the ecology, the impact on governance and on social. And you know, there's no other choice. So I met a lot of company executives which are just now complaining about the fact that I need to go in that direction if I want to get lending, if I want to get some investments, some financing. I can't get any financing if I'm not proving that I have a positive impact. A lot, because everybody is going in the right direction for the moment. Banks, financing, lending, investment, and that putting a lot of pressure on companies and on the way they will react, interact with society in the coming years. That's probably the end of the old capitalism, I would say.
Well, James Purcell, in this case, you know, I did a bit of homework before this panel. Now, you are part of a relatively young brand, correct me if I'm wrong. I know that within the portfolio of Quintet Private Bank, that there's some very old, well-established banks, but the reality is it's been rebranded. And I saw on the website there's a very strong focus on sustainability. Is it something that your company deliberately does to create a competitive edge?
Yes, absolutely. So we are a network of private banks covering 50 cities, 2,000 employees. And the reason why I joined that bank, I left UBS, where I was running sustainable and impact investing for their wealth management arm, which is of course a giant in the industry. The reason why I left that company to join Quintet is exactly for that reason, that it's a core part of the strategy of how we grow our assets over the coming years. And I think one of the most crucial parts is that the investment side, what we show our clients, and our corporate social responsibility, how we act as a firm, are put together. And it's fully congruent. What we act as a firm and what we offer our clients, they are in line with each other and they don't work on different agendas. So I believe that those that can differentiate in this space absolutely will have a competitive advantage going forward, because at the end of the day, sustainability is about people's interests, people's values, and personalization as well, and making it personal to people. And that's how we can say grow a business and have a multi-year strategic advantage in the space.
Okay. Well, my next question to you was actually going to be, does it help you attract talent? But you've answered that question yourself. You mentioned personalization. How do you, when it comes to sustainability or ESG, in your discussions with your clients, how do you do that? How do you make that personal?
So I think this is where ESG scores really fall down, because two completely rational people can have different views on the same company or activity. So earlier you were mentioning electric cars. Now, electric cars is something that some people find really sustainable for the obvious reason that they're getting rid of combustion engines and and so forth. But other people will look at electric cars and they'll look at the batteries that power them, the cobalt, the mining, the difficulty in disposal. These are all very legitimate reasons, and two different people can legitimately have a very different view on the sustainability of the electric car industry. So for us, personalization is all about understanding what matters to the client and then building portfolios that reflect their interests. So this can be people who have got a particularly strong interest in climate change, strong interest in water, strong interest in diversity, and making sure that sustainability fits their preferences, not just telling them that their portfolio is BB rated or 90 out of 100. These things don't connect with an individual. We need to make it personal. And that's what I think is the next exciting frontier in sustainability.
Right. Okay, thank you. Moving to the other James, right? Because obviously HSBC is a very old brand. It's, as I mentioned before, a giant, and giants like oil tankers are also not easy to move, right? So if you have a relatively new, young brand, you're quite nimble, 2,000 people, and you really, this is one of the, I guess, cornerstones of Quintet to say who they are. But she has always been there. So how do you take away the skepticism maybe of existing clients and staff, or convince the public that you are moving in that direction?
Well, that's a good question. And I think what's important is that first and foremost, we are going to be in an environment in which interest rates are going to be zero bound for much longer than we would like. And in such a low interest rate environment, it's a headwind for all banks. It's difficult to earn on your net interest margin as a bank. And of course, for investment asset managers, it's difficult to search for yield. But I think that in some ways, ESG investing can actually thrive in this environment. And as a bank, there is a very strong understanding and a strong recognition that ESG is not something that you are forced to do, but it's a strategy that can help you thrive in this low interest rate environment, because it helps as a big bank to allow green bonds, as an issuer of green bonds, for example, giving higher yield for investors. It helps in the lending business of which companies to finance based on which companies that are managing well on the ESG aspects. And it also helps investors also with the bank to understand that as the bank shifts and place importance in ESG, it's actually beneficial for the bank in the long run, but also it benefits the clients. And I think that's the whole shift that's ongoing for a big oil tanker like HSBC. But also, I think increasingly, as the industry also embrace much more technology, I think that's going to be good also, because it would help more digitization. It will make operations within the bank much more efficient. And of course, that would enable a better ESG score. And of course, there is a recognition for diversity within the bank. And of course, with more opinions from a diverse view, we can actually come up with better decisions to cope with a more difficult world.
Okay, thanks for that. Well, staying with you, and sorry to compare your bank with an oil tanker. I realize oil tankers are not necessarily very environmentally friendly anymore. But James, in terms of reporting to your clients, whether it's the discretionary portfolios or the generic portfolios, how do you deal with that? Because it's not easy.
Yeah, so you're right. It's a big bang. There are various parts that are running faster in this program. There are some parts that are lagging behind, and some are doing catch up. So it is a certain parts of the bank are way ahead, market leaders in terms of issuers of green bonds within the bank. There are some parts that are innovating on green deposits. So there are many different aspects of it. But of course, at the private bank, we are also putting this as a priority. A lot of these reporting are one of the top areas that we want to bring about for our clients. And of course, it involves not just the data, but also a lot of the IT infrastructure system. So it is a work in progress, especially within the private bank, in giving a more holistic reporting for our clients. And I think in the next year or so, we're going to see significant improvements, especially within the wealth space.
Mm-hmm. Okay. And Laurent, you're also part of a large financial group. Obviously, and I could imagine that the Luxembourg unit is relatively small, obviously, whereas the head office Amsterdam is huge. How do you align what you do as a satellite with the head office in Amsterdam?
We are working since years together with, for example, with the fund specialists. The fund specialists are working together. The equity specialists are teaming together also. The bond specialists too. So when we decided to adopt an ESG policy, we just have to liaise with our colleagues in Amsterdam, where there is a specific and dedicated ESG team, which is just promoting ESG behaviors behind the bank, in the banks, in the private bank, but also in the corporate banking. And it was really easy. After that, internally, we had to do a strong job by promoting and developing the behaviors. We organized green investment days for our private bankers. We have decided for some sales objectives also. Promoting the guys which are selling more ESG products than classical ones. We are creating newsletter, model portfolios. We do have in Luxembourg a work group which I'm heading with some colleagues which were really interested in ESG, which interested in promoting the ESG behavior internally in the private bank, and we do that since 2 years, and it's really successful. We already transformed some bond funds, getting some labels from LuxFlag, for example, in Luxembourg, or Febelfa in Belgium, and we are transforming our fund of funds, as I've already said. So it's an ongoing project. It's a work group. We still has I think a lot of projects for at least 5 years, and as long as there is some job to do to promote, educate, we will be there to do it. On the global level, by teaming with our colleagues in Amsterdam, which is they are giving us the expertise, the experience, as they have more than 10 years experience on promoting ESG, and on the local side also.
Right. And James Purcell, obviously we've heard in the past years more and more about this topic. It's getting more traction in the press, with the regulators, with the investing public, especially second and beyond generation. But there's also some controversies, I would say, right? You hear a lot about greenwashing. How do you deal with that?
We hear you now.
We hear you.
You hear me now or not?
Yes,
Yes, we do.
Okay. Sorry about that. It's a technical issue. If you do not actually back up what you say with evidence, then of course you should rightfully be criticised. The best way, I believe, to combat greenwashing is transparency. Be absolutely clear what your investment products do and what they don't do, and be very transparent with individuals and investors the limitations. So, for example, a lot of investments in the secondary markets have absolutely no impact. You may be able to align the portfolio to certain standards, as in remove companies that are doing activities that you don't like, invest in activities that you do like, but the actual real world impact of that decision is very limited, of course. For every buyer in the secondary market, there is a seller, and vice versa. You're not changing the capital structure of these firms. You're not therefore having, as an investor, a huge impact. And that's the transparency that we need to have in our conversations with clients. Where does the investor have impact, and where does the investor align with their values? And these are the types of conversations that we have to avoid greenwashing, to be absolutely clear the limitations of some of the strategies.